Good afternoon, everyone. On behalf of Women's and Young Committee, I would like to welcome each one of you. I would like to welcome CA Preeti Savla ma'am, Chairperson of Young and Members Excellence Committee, to the today's session. Ma'am, I would like to request you to please give your opening remarks.
Hello friends, thank you Divya, and we have with us Kavita also, who both are going to moderate this session, and both are our members from the branch, managing committee members from the branch. And today, as all of you are aware, have started this series, Unleash Your Potential. We have completed the GST part of it, and now we have started the income tax part. And today we have very learned speakers with us, CA Prachi Parekh and CA Kinjal Bhuta. So we are going to the basics. And while doing the practice or while applying the laws, the rules, the regulations, what issues are coming. So entire case study based learnings, the sharing of experience by the faculties will take you to the very knowledge sharing of knowledge by them will take you to the experienced qualifications, I can say, and a great addition in the value, because we have the acts, rules, regulation, but how to apply practically. Certain issues are coming and we are not aware how to tackle those things. So those issues will be dealt by the faculties in this Unleash Your Potential. We have specifically structured this program and this series, Unleash Your Potential, Upgrade, Upskill, and Excel. The main objective of this series is that the members who were in job wants to come in practice, or the women who have taken break in their life, in their career, and want to come back in the main path of profession and upgrade the knowledge. The technology has changed so much, so we want that the practical experience is being shared, how to actually upload the things, and how to file the required returns. So all those things will be shown practically to all the participants. So the main fundamental criteria is that we want that all our members upgrade their knowledge. And with this kind of series, Unleash Your Potential, I am sure you will gain a lot of practical experience with the learned speakers. With these words, I welcome all of you, my wonderful, intelligent women. I also welcome C. Shalini Gupta, who is a NIRC treasurer. Welcome, Shalini. You can put on your video also. Who is
Thank you, ma'am.
wonderful work at the Northern region. With these words, I welcome once again CA Prachi, CA Kinjal, both speakers, both the moderators, the NIRC treasurer. If you want to have any, share any of your experience, or if you have any suggestions, feel free to reach out to me or any of our team members, so that we can take up the issues and sort out the issue. With these words, welcome all of you and wish you a happy learning. Thank you so much.
Thank you, Preeti ma'am, for your opening remarks. Taking further the session towards the first session, our first session will be based on in salary, house property, and income from other sources. It's practical exposure, which will be helpful for many. These topics will be covered by CA Prachi Parekh. She is basically a chartered accountant specializing in the area of direct taxation advisory and consultancy. Presently, she is associated with EY in Direct Tax Knowledge and Solutions team. Previously, she worked in the editorial team at Tax Sutra, engaged in teaching taxation to CA Inter and CA Final students for past 12 years, regular speaker at various forums for professionals, regular contributory to journals and BCAS, Chamber of Tax Consultants and Taxmen Online. Ma'am, we heartily welcome you for today's session. We hope that you will be guiding all the attendees for the mentioned topics. Welcome you, ma'am. Over to you, ma'am.
Thank
Prachi, ma'am.
you. Yes. Am I audible?
Yes, ma'am, you are.
Thank you for the kind words, Divya. And at the outset, I would like to thank the YMEC for giving me this wonderful opportunity to share my knowledge on the subject of taxation. So, I would be sharing my presentation for this. And all right. I am hoping my screen is visible to all the participants. Okay. Also, for better bandwidth, I would just put off my video for a while and then sort of put it on again. Okay. So the topics which I have to cover in today's session are from the heads of income which are related to income from salaries, income from house property, and income from other sources. So these are, we can say, the basic heads of income which are applicable to a lot of taxpayers. A major chunk of taxpayers who file their returns of income are usually the salaried class. So I'm going to take you through the brief provisions for each of these heads, what it covers, what it doesn't cover, and also I'm going to touch upon the amendments which are recently made, which are related to these heads of income. So it began our discussion with income from salary. So, like I said, this is the most basic head of income which is applicable to a large variety of taxpayers, which is income from salary. Now, this ranges from Section 15 to Section 17 of the IT Act, and it contains provisions which help us to compute various categories of income which are comprising the salary component. For example, you have provident fund, gratuity, perquisites. So we have a host of rules which enable us to compute various income which falls under this particular head. Apart from that, what are the deductions which are allowed or allowable from salary income? We get to understand that. So just to give you a quick idea of what this head of income is. So we basically have the charge of income under this head, which says that any amount which you receive from your employer, whether it could be a prospective employer, it could be a past employer, and obviously the current employer would be taxable under this particular head of income. So for any amount to be taxable here, the first test which it has to qualify is that it should come from the employer-employee relationship. Now, apart from basic salary, we have a variety of emoluments which are paid, such as we have provident fund, gratuity fund, we have various perquisites such as rent-free accommodation, you have interest-free loans, there are tour and travel facilities which are provided, there is a motor vehicle which is provided. So for each and every component which forms a part of your CTC or your income from salary, we have various valuation rules in place. So whatever the taxpayer is receiving, let us say is receiving some leave travel concession. So we then have to check what is the amount he has received. We have to apply the provisions of section 10(5). We have to ascertain as to what will be the exempt component of the amount and accordingly derive the taxable amount. Coming to the deductions which are permissible under this particular head of income. So erstwhile there were only two deductions. You had the deduction for profession tax and you had the deduction for entertainment allowance. A couple of years ago, they amended and brought in the standard deduction. Now, members and friends who were practicing some time back would be aware that some time ago, the standard deduction was already in place as a what do you say, a lump sum deduction available from salary income. Later on, it was taken away, and some 2 or 3 years back, it was reintroduced. So presently, we have a standard deduction of 50,000 rupees, which one can avail if they are offering their income under the head salary. Now, there have not been really many great amendments as far as this head of income is concerned. But I would like to draw your attention to something which is of very much relevance and importance. for the taxpayers who are under the salary head of income. So some 2-3 years back, there was a concessional tax regime which was introduced, which was applicable to individual taxpayers. So we have a section 115 BAC which was introduced and which told us that if you are not wanting to go under the normal tax regime, which is the slab rates which we have, like up to 2 lakhs nil, and 2 to 5 lakhs 10%, 5 to 10 20, and above 10 you have 30%. So that is the usual normal tax regime which we refer to. So this new concessional tax regime came with an option that if a taxpayer was ready to forego some of the deductions and allowances which he could otherwise claim under the normal tax regime, he could offer his income to tax at concessional rates, so which we call as the CTR. Now, the Finance Act 23 has made a certain amendment to this concessional tax regime rates. So this is very important from the perspective of individuals who are offering their income under salary, because they have very limited deductions as far as the normal tax regime goes. Even under chapter 6A, which is your deductions chapter, they just have the basic ATC, ATD, sometimes interest on loan related deductions which they can claim. So people who have newly started earning income from salary, or who are almost at the fag end of their careers with all their investments in place and all, no HRA, etc., they can certainly evaluate whether they are more advantaged if they decide to offer their income under the concessional tax regime. So every year, the salaried employees can take this option. They have a unlimited switch in, switch off facility, as we say, and they can evaluate whether this new regime or old regime is more beneficial. Now, in the next slides, I'm going to just acquaint all of you, because otherwise there is nothing much to discuss on salaries from the provisions perspective. There are rules, etc., which we know what is to be applied if at all the particular income is forming part of my individual CTC. But this is an interesting aspect, which is the comparison between the CTR and the normal tax regime. So like I said, section 115 BAC was recently amended by Finance Act 2023. So before this amendment, we had a particular tax rate here, which you can see in my slides as the pre-amendment CTR. So we had some particular slabs where my basic exemption limit was 2,50,000. Then from 2,50,000 to 5 lakh, it was 5% of tax. From 5 to 7.5, it was 10%, so on and so forth. Now this CTR, which is also the concessional tax regime, has undergone an amendment in this particular Finance Act, whereby they have raised the basic exemption limit to 3 lakhs. So up to 3 lakhs of income, any individual taxpayer who's a resident and who's wanting to avail this concessional tax regime, he need not pay any taxes. Then the second slab is from 3 lakh to 6 lakhs, where your tax rate is 5%. From 6 lakhs to 9 lakhs is the third slab rate, where you have the tax rate of 10%. From 9 lakh to 12 lakhs is your fourth slab, where you have a tax rate of 15%. And from 12 lakh to 15 lakh, it is 20. And above 15 lakh, it is 30%. So as you can see, even under the existing CTR, which is this column here, my 30% rate was triggered only when my income was crossing 15 lakhs, which is the same right now also. But they have kind of tweaked the slab rates in between and raised the basic exemption limit. So this is the change which was brought in by Finance Act 23 as far as the CTR provisions are concerned. There has also been a change in my surcharge rates. So as you can see here, the new rate of surcharge where my income was above 50 lakhs is 10%. If it is above 1 CR, it is 15%. If it is above 2 CR, it is 25%. And earlier we had another rate of 37%, wherein the taxable income of a taxpayer was above 5 CR, which is now removed by the amendment executed under Finance Act 23. So the highest rate of surcharge right now prevalent under the ITA is of 25%. So these were some amendments in the tax rates or the slab rates as far as the concessional tax regime. Now everybody would come across a question that what is the impact or what is the implication of these tax rates being tweaked, or how is it relevant for me to decide whether I should go under the old regime? That is this part, okay, the normal slab rate part, or whether I should take up the concessional tax regime. Now, before I discuss the further slides, let me just give you a word of caution that if at all you decide to take the tax rates under the concessional tax regime, all your chapter 6A deductions, your standard deduction, these are not going to be available, right? You will just have some limited deductions which are there, which are specified. So everything which is otherwise available under a normal slab rate regime, the traditional regime, which we can say, all of it is not available under the CTR. So one needs to really kind of make a mathematical analysis there as to what is beneficial for the taxpayer, whether foregoing these deductions and paying tax at a lower rate is more advantageous, or taking deductions such as interest on housing loan, or let us say your ATC or your entertainment allowance standard deduction, and then paying tax under the traditional regime. So this would depend on a fact to fact pattern, and it would need independent analysis in each case. So one thing I can say here is on an year-to-year basis, you can evaluate this. If you do not have any income from the head business or profession, then this particular option of going in for the CTR or opting out of the CTR can be evaluated on a year-to-year basis. Going further, there has been some changes to the rebate provisions also under section 87A. So your normal tax regime, that is the traditional tax regime, and the pre-amendment CTR, your rebate was lower of 100% of the income tax or rupees 12,500 for an income up to 5 lakh rupees. Now, what is the advantage which is conferred to us by way of amendment to Finance Act 23? So if you are opting for the new CTR regime माने ये particular part जो यहाँ पर मैंने highlight किया है. So if one is opting for the new tax concessional tax regime, the income limit for applicability of rebate under 87A is raised to 7 lakhs. Also, the amount of rebate is raised to 100% of the income tax component or rupees 25,000, whichever is lower. So this is another attempt to encourage more and more taxpayers who do not have any substantial total income to take the benefit of CTR, that is the section 115 BAC. So you're giving them a tweaked tax rate, you're giving them some increased rebate, and you're trying to encourage people to go in for this new CTR. Now, this is again applicable to resident individuals who are taking the option under 115 BAC and not other taxpayers. So other taxpayers who are wanting to follow the traditional regime, their limit would be the same, that is 5 lakhs and a maximum of 12,500 rupees of rebate. So this is again an important amendment, though not directly related to salary income, but most of the times it is useful when we are computing income under those basic heads of income. Moving further, I have just kind of made an illustration as to what would be the tax savings for resident individuals in terms of this impact of rebate, which we discussed in the earlier slide. So old tax regime is the traditional regime. Old 115 BAC is the concessional tax rate before the amendment of Finance Act 23. And new 115 BAC is the amendment of Finance Act 23, which increases my rebate limit to 7.5 lakhs. So let us see what would it be under the traditional tax regime or the old tax regime. So for someone with a gross salary of 7,50,000, you would first knock off a standard deduction of 50,000, leaving your gross total income at 7 lakh. On 7 lakh, excluding the component of surcharge and cess, your tax payable would be 52,500. The rebate available in this case would be nil because rebate here is applicable only where your income is up to 5 lakh rupees. And then your net tax payable here would be 42,500, right? Now, if you look at the old CTR rates, again here, when your gross salary is 7 lakh 50, you're not entitled to the rebate because the rebate here would come to, so this should be 52,500, right? Tax payable. There's a typo in here. So 7 lakh 50,000 is your gross salary. You cannot take the standard deduction. Before the amendment, you were not able to take standard deduction for CTR. Your gross total income is 7 lakh 50. The tax payable computed basis the concessional tax rates comes to 37,500. So that is your net outflow in the pre-amendment concessional tax regime. Now Finance Act 23 has given a bonanza in the sense that not just has the income limit for applicability of rebate been raised, you can also claim the standard deduction if you are offering income under the new CTR as amended by FA 23. So here your gross salary is again 750. You claim a standard deduction of 50,000. Your gross total income comes to 7 lakhs. Since it is not in excess of 7 lakhs, you can claim rebate. So the entire tax, which is calculated at 20,000 rupees, goes, or I can say is taken away by the beneficial provisions of rebate, which is up to a maximum of 25,000 rupees. And therefore, you don't have to pay any tax. So this is the attraction or the impact which the government is trying to provide for individual salaried taxpayers who are wanting to take the benefit of the amended CTRs. Now, again, this is a very elaborate illustration. And if time permits, I would come back to it. So this is comparing the entire computation. Now, just very quickly, what I would like to highlight here for the benefit of members is that if you're going under the traditional regime for tax, vis-a-vis, let's compare it to the new CTR. As you can see, even though the deduction of standard deduction is available, your benefit of HRA, leave travel concession, any kind of interest on housing loan, your deductions under 80C, 80CCD, 80D, 80G, all of this has to be sacrificed if you are wanting to take the new concessional tax regime. So that is why I was trying to make a point that whether or not your clients or yourself has to go under the new CTR or continue remaining taxable under the traditional regime will have to be dependent upon what is the cost benefit analysis if I opt for the traditional regime or if I do not opt for it. So one has to forego all these deductions and then they can avail of the lower tax rate slabs. So the slides will be provided to the participants and they can go through this illustration in detail. What I wanted to highlight here was just the non-availability of these deductions. Okay. So now what is the points of distinction or a comparative analysis when we are speaking of CTR versus the traditional or the normal tax regime? So our analysis shows that up to 7 lakhs of your total income, or let's say 7.5 lakhs in case of salaried employee, your new CTR seems to be beneficial because then there is no tax liability under the new CTR. If your income is up to 15 lakhs, then the taxpayer needs to compare that what is the amount or extent of deductions which have to be foregone in order to take benefit under the new CTR. So you have to then analyze whether taking these deductions is better or giving them up and offering income as per the CTR tax slabs is better. After, when you cross this 15 lakh threshold, new CTR will be beneficial only if the exemptions or deductions is 3.75 lakhs and above, right? Because the maximum tax saving which you can do under the new CTR, its base is the illustration, which comes to some 1,12,500. Now, if you ask me, what should one opt for? So unless and otherwise you are having or claiming the exemption of HRA or housing loan interest, or you have taken the component of leave travel concession in your CTC, along with certain typical deductions like, let us say, TG, or you have a PPF contribution, etc. So if all these things are running and they have been in place in your case for a long time, then certainly the traditional tax regime is more beneficial. But again, don't take this as a thumb rule. It needs to be evaluated on a case-to-case basis. Because I also mentioned that I'll be touching upon some amendments for these heads of income which have been brought in by FA23. Just quickly, I would like to highlight, without going into the nitty-gritties, that as far as the perquisite valuation for rent-free accommodation is concerned, there has been an amendment. So the particular sections which deal with the taxability or valuation of a rent-free accommodation are amended, and now the central government can make rules for providing for valuation of perquisites which are provided either free of rent or at concessional rates. Also, there is some explanation is also amended that says that if the value of such accommodation which is computed in accordance with the rules is more than the rent which is recovered from the taxpayer employee, in that case, what would be the scenario? So this is just a quick information which I wanted to give away. Of course, they are very niche provisions which we would have to tackle when we come to valuation. So this is what I wanted to share as far as income from salary is concerned. So because I have two more heads of income, I have kind of quickly brushed through this. If there are any questions or we need to discuss more on any of this, we'll come back to it after we cover the other parts of my presentation. Now, the second head of income, which is again a very basic and preliminary head, I would say most of us would be offering some or the other income or loss under this category, is your income from house property. So again, this particular head consists of provisions which give us the formulate for computing income from various types of properties. So they could be a let out property, it could be a self-occupied property, or it could be a property which is lying idle, which is classified in the Income Tax Act as a property which is deemed to have been let out. Now, in terms of let out property, the computation per se is very simple. Whatever is the actual rent that you're receiving, you have some particular formula here, like you compare it with the fair rent. Together, you compare it with the standard rent for that particular property. What is the reasonable expectancy that you compare with the actual rent, and you devise the taxable component of rent. As far as a self-occupied property is concerned, the ITA provisions have been benevolent enough to give us the benefit of claiming self-occupied properties having annual value as nil. So typically, if I am living in a particular property, I need not pay tax on its annual value component, subject to some other criteria, of course. And if I have more than one self-occupied property, then the third self-occupied property has to be considered as deemed to be let out. Now, for people who are revisiting these provisions after some considerable time, we were aware that the benefit of self-occupied property was earlier available only in respect of one house property. A couple of years ago, this was amended to say that the benefit of a self-occupied property could now be availed for two properties. Okay, so if you have three properties which you are having for your own occupation, for two, you can claim the net annual value or the taxable income as nil, and one will have to be treated as if it is let out. So this was certainly a welcome amendment, because these days there are situations wherein you might have residential properties at two places, which you're really and genuinely occupying for the purpose of your own residence. However, if you are investing in properties and you're accumulating wealth, then the third property will have to be taxed. Now, what most of us don't know over here are this particular property, as to which can be taken as self-occupied and which has to be restricted to deemed let out. This decision can be changed on an year-to-year basis. So, based on what property is having a higher fair rental value, or for what particular property I have ended up paying interest on borrowings, all these factors can be taken into consideration, and you can select the two properties which you want to claim as self-occupied. And as a taxpayer, you certainly are equipped with the option of changing this decision on a year-to-year basis. So apart from the specific formulae which this head of income has for computing income from these kind of properties, it also allows the taxpayer certain specific deductions. So these deductions are interest on loan and standard deduction. Now, this interest could be on a loan which is taken for a purchase or construction activity of the property, or it could also be a loan which is availed for repairs, renovation, or reconstruction. So these five purposes are specified under the income tax provisions. If your loan is availed for any of these, if the loan is availed for any of these five purposes, you might be able to take the benefit of deduction for your interest component. I'm assuming my screen is visible. There was some error and it had kind of stopped sharing. Okay. All right. So next is the deduction for your, which is also called as the standard deduction. Now, what exactly is standard deduction? Standard deduction is basically an ad hoc deduction which is allowed to the taxpayer. So they do not give you individual deductions for any of the expenses like repairs, insurance, or some other type of expenses which you might incur in relation to the property. So the Act provides that 30% of whatever is your net annual value of the property, we will allow you as a deduction, and there will not be any other amount which will be claimed apart from this particular standard deduction which is allowable to. So these are the two deductions which a taxpayer can claim as far as their computational provision is concerned. Now, at this point, I would just like to highlight something interesting and possibly a kind of analytical. I'm sure most of us would be or would not be acquainted with all the five heads of income. But if you closely have a look at them, overview, I would say, then if you look at these first two heads of income, which is income from salary and income from house property, the peculiar aspect about these two heads of income is that what is allowed to be deducted is specified. You cannot go beyond that. And there is a complicated formula involved for computing the taxable income, which is so much in contrast with how you compute your income under business head. So under business head, you have a simple rule. Not so simple, but simple for the purpose of saying so, that any particular expenditure which you incur for the purpose of your business activity will be allowed to you as a deduction. Now, you cannot take that kind of leeway over here, where the deductions which you can claim are specified and limited. This is applicable to both income from salary also and income from house property also. So other than what is told to me, I cannot take any other deduction when I'm computing this particular head of income. Now, someone can ask a question that suppose I took a loan for buying a property, which, so we can say it's a housing loan which I have taken for purchase of a property. And then I took another loan to repay the old loan. So let us say I got the other loan at a lower rate of interest or some better tenure, or it was overall more attractive than the older loan which I took. Can I take the deduction of interest even in the case of this new loan which I have taken? So the answer is yes, because the purpose of the new loan was to repay the original loan. And the original loan was per se taken to purchase the property. So it was one of the 5 purposes for which you can take the deduction of interest on a loan which you have availed. Now, suppose, just to kind of stretch this case study further, if this loan, the new loan which you have taken, is taken to meet the interest liability of the earlier loan, would that interest on this new loan still be allowed as a deduction? I'll again repeat my situation. So I have an old loan which I have taken for purchase of property. I have been unable to service my interest for quite some period. So there is a buildup of interest on that particular loan. And I now avail a different loan. And the purpose of this new loan is to pay off the interest liability which I've not been able to. And my question is whether the interest on this new loan which I'm paying can be claimed as a deduction by me under this particular section or this provision. So the answer is no, because the 5 purposes which are covered over here don't cover a scenario where you avail a loan for payment of interest liability. So you're not going to take deduction of that particular amount. Now, another question here, as far as in a very common situation, I'm just building up scenarios, all of that is not covered in the slide. This is like the case study part Preeti ma'am was referring to. So let me give you a scenario, a very common one. So if you have purchased an under construction property. So let us say there's a building which is in progress in my vicinity and I pay some payment towards purchase of that property. The property is yet to come into existence, but I have paid, let us say 50-60% of the entire purchase price. And as in how the property is being completed, I am paying off the balance amount. Naturally, I being not so rich, I don't have the money to shell out from my own pockets on this property. And I have taken a bank loan and my EMI has already started rolling. So I am certainly incurring an interest liability for purchase of this property, but the property is not still in existence. So then what happens to this interest, which I am keeping on servicing? And let's say the property is going to take another 2 years to be up and ready for use. So under the Income Tax Act, for this particular head of income, we have a concept called as pre-construction interest. So as the name itself is indicated, this refers to the interest which is prior to the period of construction. So before actually my construction activity, or let's say before actually my property was completed, whatever interest I serviced during the pre-construction period is accumulated mathematically. And then in the year my property is ready, it's ready to be offered to tax in one way or the other, I will be dividing this accumulated interest in 5 equal installments and taking it by way of deduction from my income under this head for a period of 5 years. So that is the logic which we have for interest, which is also called as pre-construction interest. Now, certainly giving you the benefit of self-occupied properties is an advantage which is made available to the taxpayers. Also allowing you the deduction for your pre-construction period interest is another advantage. So in case of self-occupied properties, there is a ceiling or a maximum cap or a limit up to which such interest can be claimed as deductible, which is presently at 2 lakhs. So if your interest on a self-occupied property, including your current year's interest or your accumulated interest, which is your pre-construction period interest, if it is in excess of 2 lakhs, you're not going to get any deduction for that. So this is the the rider over here, and this is a little about taxability of self-occupied properties. All right, so this is something, and then the next, so we have covered what can be deductible on a very generic and a broad-based basis. The next here is taxability of unrealized rent or arrears of rent. So there might be a situation wherein there is certain rent amount which was a bad debt in any of the earlier years, or your rent was increased retrospectively and you are ended up receiving some arrears. So the simple logic which is applicable so far as the taxability of unrealized rent or arrears of rent is concerned is that to the extent this amount was not taxable earlier, it will be taxed in the current year. So you'll be doing a working. At times your fair rental is more, so you might end up paying more tax than the actual rent which you earned. So you have to reduce that extra amount from your unrealized rent or arrears of rent, and only the balance amount would be taxable. So this would again, this unrealized rent or arrears of rent would again be subject to a standard deduction of 30%. Now I would like to bring to you a very exciting amendment which was brought in by Finance Act 23. And it sort of puts to rest a very big controversy or a very big, debate which was on for quite some time. So like I said, the interest on housing loan, which I discussed in detail earlier for a self-occupied property, is allowed under section 24 when you are computing income from house property. Now, some class of professionals and taxpayers would also take deduction of this interest when they were computing capital gains on sale of such a property in terms of section 48, that is your cost of improvement or cost of acquisition. For example, let us say I have been claiming income from house property. I have some rental income, or let's say I have a self-occupied property and there is some interest which I'm paying. This car I'm taking deduction under the ITA provisions on a year-on-year basis. Now I happen to sell this property. So when I'm computing my capital gains, my purchase price would represent my cost of acquisition. And there would be this interest which I might have paid over the years for the borrowings which I made to purchase the property. So some taxpayers used to take this interest as deduction while computing their capital gains. And this was supported by at least two rulings which I am aware of. One was of a Madras High Court and another one was a Jodhpur ITAT, if I'm not wrong. So both these rulings allowed the taxpayer to claim interest as a deduction while computing capital gains. Now, it doesn't really need too much of effort to understand that the taxpayer was somehow claiming deduction twice to a limit, I would say, because IFHP there were always limits if it was a self-occupied property. Again, if it was a let-out property, you could claim this interest without any limits. So because of this particular practice, what was happening was you could claim deduction under IFHP also. And later on, when you were selling the property, you could claim deduction of this interest in terms of capital gains as well. There was one particular Bangalore ITAT ruling which was against this practice. And there was a lot of debate. So this Finance Act, that is 23, decided to put a kind of a conclusion to this debate which was going on. And now the Act has specified that the cost of acquisition or cost of improvement when you're computing your capital gains will not include any amount of interest which is claimed as deduction under 24B. That is when you're computing your house property income, or even in terms of Chapter 6A. Now, Chapter 6A mein ye kahan aayega is sort of a mystery, but let us say there is a provision called as 80EE to my mind, which allows first-time home buyers some deduction of interest, subject to certain criteria that property stamp duty value should be up to 50 lakhs and it is in a tier 2, tier 3 city, etc. So they have, out of abundant caution, now specified that if such interest is claimed either under IFHP or as a deduction under Chapter 6A, we are not going to allow you this amount when you're computing your capital gains. Now, the trick here is that this amendment is applicable from AY 24-25. That is PY 23-24. So it might still give you a view that up to PY 23-24, if there is any interest which you might have paid, so you can just make a working for it in keep, so that if you happen to sell that property in future, there could possibly be a view that the such interest would be allowed from the cost of improvement. However, this is just a far-fetched analysis of the amendment. Please don't take it as professional advice. But it is very interesting that they have clarified it this way and not dissuaded the earlier deductions which taxpayers might have claimed. So this was about the recent changes in income from house property. I understand I have about 10 minutes more, including a Q&A session. And it also brings me to the last head of income I am acquainting you all with, which is income from other sources. Now, this is, I can say, the residuary head of income, because after income from salary, income from house property, you have business income, capital gains, and then whatever else remains, which is not covered specifically in the first four heads of income, goes and falls in income from other sources. Now, the highlights of this head of income are where you have taxability of gifts or taxability of dividend income, or there are certain provisions for closely held companies, wherein if they end up receiving shares, if they receive any amount on account of transfer of shares at a premium, which is more than the fair market value, those amounts are also taxed in the hands of the closely held company under this head of income, which is 56(2)(10). Earlier it was 56(2)(7)(b), etc. They're also called as angel tax, right? So these are the highlighting aspects of this. Now, taxability of gifts is something which was brought in by Finance Act 2009. So since then, we are having this various issues around taxability of movable and immovable property, which is received by way of gift. That is, I would say, the most happening part of income from other sources. So if you end up receiving some amount of cash from anyone other than your relatives, and for anything which you have not done, so it is basically without consideration, then that amount is taxable as a deemed gift in terms of income from other sources. Also, if you receive some shares or some paintings, some jewelry, some other work of art whose FMV is in excess of 50,000, and you have received it totally without consideration, or the amount which you have paid for it is inadequate, so as to say the fair market value and the amount which you have paid for it, the difference between these two is less than 50,000. In these cases, that amount is going to be taxable as income from other sources. Now, there are various valuation rules like 11(u)(a), which are in place to ascertain as to what could be the fair market value of the property which you have received. As far as immovable property goes, the stamp duty value is often treated as is treated as the fair market value. So this is the generic outline of this chapter. There are certain exemptions, like if you're receiving it from your relative, or if you're receiving it under a will or inheritance, or on the occasion of marriage, then such gifts are not taxable to the recipient. Apart from this, also if you're receiving it from some local authority or in contemplation of death of the giver, then also these amounts are not taxable. Now, this is the brief about what is important in this head of income. Now, I would like to just touch upon the recent amendment here, which was a very major amendment, I would say. And one amendment took place in the finance bill, the other one took place at the enactment stage. So basically 56(2)(7)(b), which deals with the angel tax provisions. So wherein a closely held company is receiving some amount on account of transfer of its shares, which are at a premium. So these provisions were earlier applicable only when resident investors invested in these kind of companies. Now, this scope is also extended to non-resident investors. So if a non-resident investor is buying the or I would say investing in equity shares of a closely held company, and he's paying some premium amount which is more than the fair market value of those shares as valued, then that excess amount would be treated as taxable in the hands of the company under the head income from other sources. Now, this particular provision that it is also covering non-resident investors is applicable prospectively, because what has happened is we are saying that investments made by non-resident investors in equity shares of closely held companies. So they have omitted the words with effect from 1st April 24 appearing in the amendment. So being a resident which was omitted. So this means that whatever investment was made by non-resident investors in such equity shares prior to 1st April 24 will not be affected by this amendment. And henceforth, going forward from 1st April, if a non-resident investor is investing in such equity shares and paying a premium, only then such amounts will be taxable in the hands of the company under these provisions. So this is the amendment which I wanted to highlight. Apart from this, there is a lot of widened scope as to what could be taxable under income from other sources and what could not. So we have various case laws and practical situations. Just to what comes to my mind, most relevant and important is we have a lot of buildings or real estate which is going in for redevelopment. So there are a lot of cases where the builder who is proposing to redevelop your existing premises pays certain rent to you. Or alternatively, the builder pays certain lump sum amount to you to take care of your expenses of dislocation. So wherein you're required to move to some other place. Now, while recently we do have a decision which has said that such amount is not taxable to the recipient taxpayer, but this is still not free from another view, and there are a lot of debates whether such amount which residents of a building going in for redevelopment, which they receive, are taxable under other sources or not. Another common example is a lot of housing societies install some banners or some mobile company towers on their terrace or there some parts of their buildings, and they receive some rent. So there also there is a deliberation or a debate as to this particular rent which is received from these kind of raising of these kind of banners or such towers, whether it is taxable under other sources or whether it is taxable under income from house property. So there is a lot of practical issues as to what would be taxable under this head or not. And it is very interesting to analyze that because, like we discussed in the first slide, this is as such a residuary head of income. So any receipt which is taxable and is not covered specifically in my 4 heads prior to this runs a risk of being taxable under income from other sources. So with this brief discussion on the 3 heads which were allocated to me, I would like to end my discussion. And if at all there are any questions which we need to take up, we can do that.
Thank you, CA Prachi, for your wonderful insight into all the 3 heads. There are a couple of questions. I'll just take those questions. This one question is from Kainas Wazifdar. Amounts or assets received on death as a legal heir, is it required to be disclosed in ITR? And if yes, relevant places of disclosure, relevant places to disclose.
So while I don't know the exact nature of assets which may be received, there is certainly a schedule called as EI, which is exempt income, and also your other sources OS. So at certain times, there is a requirement if there is any immovable property or some shares which are being received as a part of inheritance, which you might have to disclose. So one cannot take a blanket view that there is no need to disclose these assets. While they might not be taxable, adequate disclosure would be imperative.
Thank you. I think, yeah, that's it. That's the only question what we have. Members, if you have any further questions, you can post it now. Since we have the expert here, you can wait for a couple of minutes and then wind it up, Prachi madam.
So,
There seems to be no other questions. So we will proceed and make the way for the next session. And CA Prachi Parekh, thank you so much for taking your valuable time and then addressing our members, women members, especially on these three relevant topics. And it's quite a vast subject and difficult to combine all these three: income from salaries, house property, and income from other sources into 1 hour session. Definitely compressing that is a tough job, and you have done the tough job very well, which has gone into in a very smooth way. And I'm sure members, all the members have been benefited under this. And if there are any questions or anything, if we receive on the further questions, if we receive, we will forward it to you for your expert opinion, ma'am. Thank you so much.
so thank you once again.
Thank you. So, good evening, members. Now we will move on to the next session. The next session is about the capital gains, which is again an important topic for all of us. The whole session is scheduled for on the capital gains, which is the basic understanding various provisions for different types of securities and exemptions under Section 50, and how to fill the same, how to reflect this capital gains into the ITR. And this session will be addressed by CA Kinjal Bhutta. So Kinjal Bhutta, CA Kinjal Bhutta is having a work experience of more than 15 years in the fields of direct and international tax. Currently a tax litigation practitioner and does representations at ITAT and other authorities. She is the managing committee member of Bombay Chartered Accountants Society and core group committee member of Direct Taxation Committee, convener of Seminar and Membership Development Committee of BCAS, that is again Bombay Chartered Accountants Society. She has authored publications on Practical Guide to Faceless Assessments and Appeals by Bloomsbury Publications House, and also on Presumptive Taxations by the publication which happened by BCAS. She is the co-editor of the Referencer, an annual flagship publication of BCAS, and contributor to annual budget publication of BCAS. Kinjal contributes various articles to journals like BCAS, Chambers of Tax Consultants, AIFTB, etc., and is a regular speaker at various forums. She's been awarded with Rising Star Award 2022 in APAC region for category of tax dispute resolution by International Tax Review. And it's a pleasure to have you, Kinjal Bhutta ji. Thank you so much for taking your time out and then coming here on behalf of the Women and Young Members Committee. I welcome you to this session, and over to you for addressing the members.
Thank you so much, Kavita ji, for your kind and warm introduction. So, good evening, everyone. And it's my pleasure to be delivering a session for this particular committee. So I thank the office bearers and the Women and Young Member Excellence Committee for inviting me over and giving me an opportunity to express my views on this particular topic. So just share my presentation. It's visible, Kavita? Okay.
Yes, it is.
So yes. Yes, now next comes after the more prominent three heads of income is the head of capital gains. So I have been given to cover the provisions of capital gains. Though capital gains itself is quite a wide topic, and we see that most of the litigation which pertains to domestic taxation areas are into capital gains and secondly business and profession. So this is one of those areas where there are a lot of different litigation aspects which a practitioner or any chartered accountant for that matter would have to face in day-to-day practice or day-to-day work. And one of the reasons why there are a lot of litigative areas involved is because the capital gain provisions have been amended over the period, and there have been a lot of intricate sections, subsections, provisions, conditions when it comes to, computing the cost, computing the sale consideration, or computing even the tax rates, which rates would apply to which particular gain. So yes, because of all these varied reasons, there are a lot of issues which get involved. So today's purview of my presentation would be sticking to the basics and the relevant legislative provisions and the concepts to brush up our knowledge on account of capital gains. So what shall we cover today is basically an broad outline on what is what all encompasses the income under the head capital gains. So I have basically divided not only the presentation, but it is this in the way in which the scheme of act is for the income from capital gains. So basically, income from capital gains ranges from section 45 to 55. Yes, there are only 10 sections on which so much of controversy relies and bases upon. So basically, simply as we put it, as we all know, the basics of capital gains is that obviously there is a sale of property, there is a capital asset, there is a transfer of capital asset. Then in that case, you consider that what kind of transfer it is, whether it is a taxable transfer or not, whether it is an exempt transfer, because there are sections, subsections which provides that there are certain transfers which will not be considered as taxable. And then we, after determining, whether it is a capital asset or not, whether it is a transfer or not, and after determining that yes, it is taxable, you get into the computational provision, which is that how do you compute a capital gains, or how do you compute the profits or losses on the sale of a capital asset. So those are the computational provisions which are being provided. And yes, after all, every section would have certain specific mechanisms to deal with certain kind of scenarios. So yes, there are certain specific scenarios when it comes to capital gains also. So there are certain specific provisions which do not come into the outlay of normal capital gains computation or calculation. And there we have certain specific exemptions. The most varied or probably I would say a distinctive feature of capital gain provisions is the varied sections of exemptions which are provided under the capital gains. We all know that there are certain sections where you get exemptions from capital gains totally when you reinvest into certain categories of assets which are provided. So that is when it comes to exemptions on reinvestments. And obviously at the end, there are certain definitions, terms, etc., which have been specified. So the idea is to, in this 45 minutes to 1 hour to brush up on the entire topic. And obviously I'll take questions towards the end. Also, before I get into the detailed presentation, since this topic is a kind of a very wide arena, I would have taken in the presentations not all the sections, not all the provisions, but the relevant ones, the ones which are the most bringing and emerging areas where we deal into the same on day-to-day basis. So from completeness point of view, it may not be a complete provisional presentation, but yes, there are certain relevant provisions which are being covered today. So now coming to the charging section. So obviously every head of income will have a charging provision. What is a charging provision is basically that particular section, which is the section which determines the entire chargeability of the next 9 sections which are provided into capital gains. So section 45 is one of the most important charging provisional sections of capital gains, and it specifies that what could be taxable when it comes to capital gains. Just divided and digressed the section into small parts, that what is to be charged as per capital gains. So obviously there has to be some profits or gains. Obviously profits includes losses too. So there has to be some profits, gains, losses. On what? On account of some transfer. So the three most important, rather four most important criterias to bring capital gains to taxation in one particular year is that first, there has to be some profit gain loss. So this is, quite germane, and it seems that it is quite ordinary, but there is a lot of litigation arising on whether there is any profit or gain or not. So, there have been a lot of litigation around this particular very simplified versions wherein they say that, if there is no sale consideration, if there is no cost of acquisition, or if there is no gain or loss, because the assessee is not neither gaining or losing, then the capital gain provision or capital gains mechanism fails. And there have been provisions, there have been decisions, including the apex court decisions, wherein they have specified that when either one of the element is missing, which means that when there is no sale consideration, or when there is no cost of acquisition, or when there is equity, there is no profit or gain at all out of this transfer of capital gains, then the computational provisions provided under section 48, read with section 45, those provisions fail, and that is why capital gains would not apply. Obviously, all those decisions are completely fact-based, and one has to look into the specific facts of the case. But my reason to highlight it out here is that each and every limb provided in the section of the charging provision is relevant while determining the applicability of capital gains taxation. So yes, there has to be profits and gains. There has to be transfer, right? If I receive, consider an example that if I receive particular capital asset, suppose I receive a particular capital asset on account of provision of certain services, and if I gain through that, it may be an intangible gain. Will it be considered as capital gains? No, it will not be considered, because there is no transfer. So what is transfer, what is gains, etc., and what is capital asset, we will get into the next few slides of the presentation. But for us to know that it is transfer is very relevant. If there is no transfer, there is no capital gains. Then obviously it has to be a capital asset. Now, what is a capital asset? There is a definition which is provided under the Income Tax Act. Again, a lot of host of controversies on what is a capital asset and what is not a capital asset. But one has to be ensured that it is a capital asset as per the provisions of the Act. And this transfer should have been effected in the previous year. So if I have received certain capital proceeds on certain capital assets after 4 years of transfer, now when is the point of transfer and when is the point of taxation is a huge area of litigation, and it is literally a gray area. There is no white and black answer. There is no standard regulations or procedures by which you determine that in which year the transfer should be considered and in which year the capital gain has to be chargeable. There have been practically lots of issues, especially to give an example with respect to transfer of immobile properties, because when it comes to transfer of immobile properties, there are different dates, when different events when you transfer a property. So suppose when it starts right from the purchase. So normally in many cases there is a booking amount, right? There is a booking amount which is paid, and when you pay the booking amount, you get an allotment letter. So that is the first stage. This stage may be missing in many situations, but yes, that is the first stage in which you purchase a property. When that allotment letter has been done, then there are certain kind of installments which has to be paid. In certain cases, there is an outright payment, but in certain cases, there is installments. So there is that flow of consideration. That is the second event when it comes to transactions of properties. Third will be when the agreement is signed or entered into. Fourth will be when the agreement is actually registered with the stamp duty authorities or the government authorities. And obviously, fifth will be when the possession has been received or no possession is received at all. So these are different, just giving an example with respect to immobile property. Of course, capital assets will encompass many other such assets. But since lots of litigation, circles around the immovable property, I chose to give an example regarding to that. So now the question is, which year do you tax capital gains? In the year in which there was allotment, in the year in which it was possession was received, in the year in which the substantial amount was paid, or in the year in which the possession was parted away. So there obviously there is no answer which I can provide here, because as I mentioned earlier, everything will depend upon exclusive and specific facts of each case. But the rationale to bring it out here is that this first subsection 1 of 45 is extremely important, though it is a single line charging provision. However, it defines the crux of the capital gain section. Then obviously this is the direct provision, but there are certain subsections wherein they have made a specific inclusion of what is chargeability under the capital gain provisions. So when there is any money received, or there is any asset which is received under the insurance policy by way of a damage, suppose your particular capital asset, your property premises have been demolished or have been destroyed because of the flood or any accidental war, natural calamity, etc. In such situations, any amount which you receive as from the insurance, that amount, obviously the entire amount cannot be considered as capital gains, but any profit element. So you remove your, obviously the WDV if it is a block of asset, or you remove the cost which is being given to you, and over and above whatever is the gain will be capital gains. Any profits which is received under ULIP policies. Another interesting element which have been part of the act since several years, and it has been subject to a lot of amendments year to year, is basically when a capital asset is transferred into stock in trade. So whenever the capital asset is transferred into a stock in trade, which means that it enters from your investment into your business books as a stock. So if it enters into your business book, then it no more, though the asset may be there physically available, but it may no more be considered in the capacity of a capital asset. It will now be considered as a business asset. And once it is converted from the capital asset to business asset, then there will be trigger of capital gains. When is the conversion happening? So what happens is, obviously when there is a transfer, there are two stages of transfers which it takes place. One stage of transfer is when the capital asset converts into another business asset which goes into the books of accounts. That is the point of taxation where the capital asset ceases to exist because it becomes a business asset. And when you sell, when you put that into sale, or you sell that particular stock in trade as a stock in trade of the business, at that time when you sell the stock in trade, it will be considered as income from business and profession. So on what amounts it will be considered is basically the fair market value as on the date of conversion of a capital asset into stock in trade. That will be considered as sale consideration when you calculate or compute capital gains. Cost will be obviously your original cost of acquisition. And when you sell your stock in trade, the fair market value which you considered will now be considered for the business as the initial point of cost, and obviously the actual sale value. So that is how you compute and divide whenever there is a conversion of capital asset into stock in trade. So another would be specific provision, charging provision would be capital contribution by a partner. So any capital contribution which is given by a partner or a member of a AOP or a BOI into the partnership firm, that will also trigger capital gains, because the partner is alienating the capital asset from its own capacity and contributing it to the firm. So when it is the alienation of rights from an individual capacity to the partner capacity, there is that rights which are given up, and that is why it brings about the chargeability. Distribution, another is reverse. So when there is a dissolution of a firm, partnership firm or AOP or a BOI, what happens is whatever capital assets are there, they are normally either sold away or distributed on account of dissolution. So whenever there is a distribution of capital assets, they cease to exist and there is a trigger and capital gains is taxable. Then any person who receives out of this dissolution. So suppose if there is a dissolution or there is a change in the partnership structure, there is a reconstitution of the firm, then section 45(4) has been recently amended because there have been changes in the provision. There are changes with respect to 45(4) and section 9B, which is a deeming section, which says that any person who is receiving any capital asset or money on the reconstitution of firm, then there is a specific formula which is given under section 45(4), which has to be applied to derive the capital gains. So obviously section 45(4) and section 9B is a different point of discussion altogether. Probably there is an R which we can give it to that. So I have definitely not included the specifications. But for us, it is important to know that this is within the chargeability provisions. Then any transfer by way of compulsory acquisition, we are all aware that there are compulsory acquisitions which are made by government authorities. So one of the most simplest examples is that, whenever there are these metros work which is going on, or there is any reconstruction, or there is any government infrastructure is being built upon, and at that point of time, there has to be some compulsory acquisition or the asset of the immovable property which is broken away, which is coming into way. So those kind of compulsory acquisitions which are made by government authorities or state local authorities, that will also be coming under the capital gains. This also shows that intention to is not relevant. So what is relevant is there is transfer of a capital asset. Why I would mention that is that in many other heads of income, there comes many times there comes a situation where the intention of the assessee is ascertained. However, when it comes to capital gain provisions, the provisions are very clear as to when there will be chargeability which will be attracted. And of course, 45(5)(a), which is a fairly new provision, not recently added, but yes, added a couple of years ago, which is in case of joint development agreements. So this is with respect to joint development agreements or any such agreements, even redevelopment agreements, where it is not a classic case of transfer. So what is a classic case of transfer is that I have a property and I sell it, and there is a gain on the property. I receive the sale consideration, I offer for capital gains. That is a very simple, plain vanilla capital gains computation. But when it comes to joint development agreements, there is a builder, there is a developer, there is a landlord, and there are different people who are involved who purchase the property which is jointly developed. So there are different parties when it comes to joint development. Same is in case of redevelopment, where there is already a building and there is a landlord and there are tenants. The land is with the landlord. Tenants hold the property which is apperent to the land. They come into agreement with a developer to demolish the existing building and bring up a new building based upon the extra FSI which is available. And there is a new property which is being given to the existing tenants of the building. So these are some very specific complex kind of structures where capital gains have to be computed in a different way, because this is not a normal procedure in which the capital gains has to be computed. And whenever there are such complex structures, there are lots of agreements, there are lots of events which occur during the entire cycle of this capital gains. So in such cases, there was a need that, we will come to the specific provisions of section 50C, which are deeming provisions. But what happens, when there is a joint development agreement or a redevelopment agreement, there is a lot of years, a lot of span of time which is involved. And in such cases, many times the date on which the agreement is entered into could be very far away from the date when it is actually executed, when it is actually registered. So it is not necessary that all the events could be put up together in one financial year or one previous year. In such situations, subsection 5A specifies as to when it should be considered that capital gains shall be taxable. So it has been specified that in case of joint development agreements, obviously this provision is specifically made available for individuals and HUFs, because those are the people who are the ones who purchase or who are to be considered beneficial for this particular provisions. So if the capital gain shall be in the year in which the completion certificate is received from the competent authority, and stamp duty shall be considered based on that date. Why such provisions? As I mentioned, because many a times what happens is that these projects get stuck up and there are a lot of years which are involved, and then the assessee gets into a trouble because registration is done in some particular year, the completion is done in some particular year, and the income tax authorities may want to prepone the taxability. And to avoid that and to bring that clarification, because there has been a long run dispute when it comes to joint development agreements. So that is why this particular specific provision, again, given that this provision is only for individuals and HUFs, so all those litigation or disputes which are pending before the courts continue to be disputed for all other kind of persons, which is company, firms, LLPs, etc. So this is basically a very brief overview of the chargeability. Now coming to specific elements of the chargeability, which we saw in section 45. So brushing up our basics, that what is a capital asset. So capital asset is basically, as we know, that it, as specified under section 214, that it is any property of any kind which is held by the assessee, whether or not it is for personal use or profession. So that is, the usage is not relevant. When it comes to capital gains, it has to be property of any kind. Specifications which are involved is that securities which are held by FIIs, foreign institutional investors, unit-linked insurance plans, to which obviously the exemptions under section 10 does not apply. The definition of capital gains is wide and it is exhaustive. It is not specifically mentioned that what is to be included, but what is to be excluded is being specified in the capital asset definition. So any asset which is used for personal use will be excluded from capital asset, except jewelry, drawings, paintings, sculptures, arts, etc. Except for this specific basket of categories which was provided, any personal use asset is excluded. So suppose if you have a motor car which is being used for your personal purpose, and then you sell it off and take a new one, then that will not form under capital assets, because it will be considered as personal effects. Any variable personal effects will also be excluded. However, for example, if you have gold coins, silver coins, gold bars, that will be very much capital asset, because that is not a personal effect, that is not a personal variable. So that is why it, and anyways it is excluded under the jewelry category. So anything for personal consumption will be excluded from the definition. Stock in trade, so if it is a capital asset, so suppose if there is machinery, but you are into dealing of trading and or manufacturing of machinery, then that machinery is your stock in trade. And that is why, though it is a capital asset, but since it is held for your business and profession for sale, that is why it is excluded. Agricultural land, like for agricultural land, what is an agricultural land and what are the specifications has been specified in the capital assets section. So I have not brought into those specifications in the presentation today, but just to give a brief overview, there are certain specifications which are given, that it has to be an agricultural land which has to be used for the agricultural purposes. Then it has to be outside the cantonment board or municipal limits. There is an 8 kilometers aerial municipal limit which has been given. So one of the practical issue which comes up, in case of sale of an agricultural land, is to understand that how do you understand that whether it is an agricultural land or not. So this will depend upon the practical angle of it is that it will depend upon reading of the agreements. Every agricultural land will have a Satbara extract, which is 712 extract, which we normally call. If it is an irrigable land, which means that if it is producing, if it is giving any production, agricultural produce, then what kind of agricultural produce is there will be provided in the 712 extract. Further, if there is any land which is not an irrigatable land, which is a barren land on which there is no produce, then it will not be considered as agricultural land. So it may be considered as agricultural, but it will not be a rural agricultural land. It might be an urban agricultural land on which there are certain specific exemptions available, but it does not go outside the capital asset property. So many a times, we get such issues and faced by a lot of clients that whether you compute capital gains or not on that particular land. So in that case, what has to be done is you have to obviously do the reading of the agreements. There may also be a valuer officer which may be involved, a registered valuer officer who can inspect the land and give a certificate that yes, there is an agricultural produce. What is an agricultural produce? Whether fruits, orchids can be considered, whether animal husbandry can be considered, whether small plantation or nursery can be considered. For all of these things, we have rules and past decisions and judicial precedents, which one has to get into to find out. But yes, just to understand that if basics or I would lay the normal yardsticks would be that if it is a proper kind of an agricultural land in a rural area and you are doing some kind of a farming activity or any kind of agricultural activity, then it will be exempted. There are these gold bonds and gold deposit bonds. So nowadays we have those gold bonds, etc., which are there. Very less of the 6.5% and 7% gold bonds, but those kind of specific bearer bonds will also be excluded from the capital gains calculation altogether. Now, what is types of capital gains? We all know, I think, that there are two types of capital assets, which is short-term and long-term. So there are definitions which are provided. Section 242A is a definition of short-term capital asset. And that specifies, there are various categories which specifies that what will be a short-term capital asset. But certain basic parameters, as I mentioned, that the section 242A is very long section and it has the holding period determined in various different scenarios, more than 15 scenarios which they have brought about, wherein they have specified that what could be considered as the holding period. What is a holding period? Holding period would be nothing but basically how long the asset is held by the assessee from the date of acquisition till the date of sale. So there are three different time periods which are involved, which I have divided the capital asset category into. So listed securities, shares, securities, bonds, debentures, units, which are listed in recognized stock exchange. Those will be considered zero coupon listed bonds, unit of equity oriented funds. Those all will be considered as short-term capital asset if it is held for less than 12 months. If it is held for less than or equal to 12 months, and if it is held for more than 12, it will be a long-term capital asset. In case of unlisted equity shares or in case of immovable property, which includes land and building or both, in such cases, you will be considering 24 months period. Now, often a question comes that, what in case if there is an immovable property, there is immovable property is not sold, but there is a right which is sold in the immovable property. The section is very clear that immovable property, which includes land, building, or appurtenant thereto, nothing has been mentioned which is respect to the rights or alienation of any rights with respect to immovable property. In that case, in many scenarios, you will come into the 36 months bracket and not 24 months bracket. So that has to be seen from fact to fact basis. And yes, the higher limit of 3 years, which is being given, is in case of unit of debt oriented funds or unlisted securities other than equity shares and any other capital assets. So obviously, when I mention about the extinguishment of rights or alienation of certain kind of right-based assets, or any kind of intangible assets, that will be forming part of the 3 years period. So this is just a specific basket. Now, why it is relevant to divide the asset? Obviously, the simple answer to that is that there are different tax rates with respect to short-term capital assets and long-term capital assets. So the tax rate structure I have not provided in this presentation because that is quite easily available to each of us, and it is easily available on net too. But just to brush up on the basics is that if there is any equity share, which is a short-term capital asset, and which is listed, and there is an STT transaction tax paid, then it comes into a 15% tax rate. And in any kind of other kind of short-term capital assets, it goes into the maximum rate of 30%. When it comes to long-term capital assets, we have the rates of 10% and 20%, and it depends upon whether the indexation benefits are taken or not taken. So that we will come to later on. But the entire reason of categorizing into the type of capital asset will be basically just to find out the taxation element of it. Now, the entire crux of the capital gain section depends upon this section and the next section, which is what is transfer and what is not a transfer. So there are quite a few issues, but let us get into the basics of what is a transfer. So it is being defined under section 247. So any kind of sale. So obviously sale will be an outright sale of any particular capital asset. If, as I mentioned about an example of plain vanilla sale of property or sale of equity shares, that will be considered as sale. Then there is exchange. So if there is any exchange of a capital asset, then it will be considered under this provision. So one of the example I have already mentioned about exchange is redevelopment, because there is an exchange of an old property, or my tenancy rights in the old property are exchanged for getting a new property into the new building. So that will be exchange, and that will trigger capital gains. Relinquishment of assets or of rights. So not only sale and exchange, but even as I mentioned that intention and voluntariness is not something which is a domain of capital gains or transfer. So it is not necessary that I have willingly parted away by way of a sale or exchange. There might be some compulsory acquisitions also. There might be certain relinquishment of my rights also, or there may be certain extinguishment of my rights. So one of the classic example, which is specifically included in section 45, if there is my factory building and everything, there is a fire and all my assets and my building property has been put to fire, and there is extinguishment of my extinguishment of the asset as well as my rights into the assets. Also, if there is there is any assets which I have specifically, but I have parted away the rights. So basically tenancy rights, then sub-tenancy rights too. Then there will be lease rights. So all of these rights which are there, which are associated with the property, that rights, if I part away, then that right will also be considered as transfer. So one very interesting case which I would like to share here is that when we consider of extinguishment or sale of rights, we often relate it to any kind of immovable property or in with respect to that particular asset. But when it comes to capital transfer definition, it does not necessarily say that it has to be any rights with respect to any particular capital asset. So in one very unique case of ours, wherein the assessee gave away the right to sue. A right to sue would be right to challenge the legality of a particular agreement. And if one, so there was a case of ours wherein the right to sue was alienated, wherein the assessee had got alienated the right to not argue or file a countersuit in the court of law. Consideration which was received by the client was also considered as capital assets. So it is not necessary that it has to be with related to a capital asset. Then conversion of asset into stock in trade, we have already dealt with. Any maturity or redemption of zero coupon bonds, we had seen that zero coupon bonds forms part of capital asset. Any transaction which allows possession to be taken as part performance. So this specific provisions come with reference to section 53A of Transfer of Property Act. So when there is a possession which has been transferred, or there is a part performance, which means that there is a substantial performance which is made with respect to the property, wherein the possession has been taken over, or there is substantial performance which is being done, then as per the Transfer of Property Act, it will be considered as transfer. So that particular element of Transfer of Property Act, they have considered under the definition of transfer. Any transaction which has the effect of transferring an immovable property. So this is an residuary provision which says that any transaction which you enter into, which will bring an effect to make a transfer, then it will be considered. Obviously, one of the important criteria which I had mentioned at the start itself, that just because there is a transfer, that doesn't mean there will be capital gains. It may be a transfer as per section 247, but whether there was gain or not on that transfer, whether that transfer was of a capital asset or not, and whether it was in that particular year or not, will determine the capital gain applicability. So it doesn't mean that there was a transfer, that means there is capital gains. Lot of issues when it comes, as I mentioned, when it came to joint development agreements, which is a hot debatable topic, or when it comes to in case of immobile properties or consideration, even when it comes to transfer of shares, right? So alienation of shares, whether the shares were capital asset or not, when it will be considered as transfer, there are a lot of issues involved that on the point of transfer. So when it comes to immobile property, I have already discussed various areas, where in which year it will be taxable. Same is with respect to shares, that when you consider it as transfer of shares, when it is allotted, when it is transferred, when there is a transfer share purchase agreement which has been entered into. So those are different areas which one needs to get into. Which is a complete, again, a factual angle, but this all will come under the domain of this particular specifications. Now, what is transfer has been already mentioned. What is not a transfer is also mentioned. So section 47 has host of provisions, almost more than, I think, 25 or 26 odd provisions under section 47. Which says that what will be not considered as a taxable transfer. So this is famously called as exempt transfers. I have just listed down the provisions. Each of the provisions, is to be gotten into detailed, because there's a detailed write-up for capital gains on each of these provisions. But the most famous ones, which we are aware of, are basically when there is a distribution of capital assets on case of partial or total partition of an HUF. Then there is a gift or a will. When you inherit a property under a will or under an irrevocable trust, then it will not be considered as a transfer. It will be considered as a transfer when you sell that inherited property later on. for consideration. But when you have inherited at that point of time, or when you have received that as a gift at that point of time, it will not be considered as transfer. Then any transfer by a subsidiary company to its holding company or vice versa, any transfer in scheme of amalgamation, in scheme of demerger, in scheme of demerger between two foreign companies or between two Indian resident companies. So this all comes with lots of provisions and caveats, which obviously due to lack of time and the restricted amount of coverage which we have to take up, I have not considered here. But when a situation comes, one has to refer to section 47 to find out the specific provisions and conditions which are given to effect that it is not a taxable transfer. So any conversions of bonds or debentures into any other certificates from a company, so that any transfer of capital asset from a SIC or industrial unit. So the major, obviously there is no simple or single bracket in which these provisions come into, but the idea behind this non-taxable or exempt transfers is that when the character of a capital asset is partaking a character just because of reorganizations, just because of any particular event like like SURFACE or SIC industrial entity or going into bankruptcy, or when there is a there is a death or a gift which has been given. So although the hands from which the capital asset being transferred changes, but there is an event which is involved into that, and that event should not be considered as transfer because it is an event between two known parties or one and the same party, or a reconstruction of business. So when it comes to so most of the section 47 provisions which we see are reconstructions of firms, companies, amalgamations, mergers, demergers, business reorganizations between banks. So most of those things, securitization and demutualization of stock exchanges. So basically it is dependent or contingent upon an event. So that is when when they found out that they have kept on adding under the section 47. So if you fall into section 47, then there is no capital gains at all. So you don't even compute capital gains, right? Because section 47 is a notwithstanding provision to section 45. So if you fall into any of the categories, then you don't even have to disclose that in your return of income, because obviously if there is any specific provisions or schedules given in the ITR, then you will have to show it, but otherwise you will not put it into the section 45 itself. Now coming to the mode of computation, section 48 and 49 are the two important provisions which drives the entire computational mechanism of capital gains. Once you know what is a transfer, once you know what is a capital asset and when it is to be considered as transfer, you compute capital gains in the way in which it is provided under section 48. Section 48 basically says that how do you compute? So the simple standard method we all know, that you have to find the full value of consideration. What is full value of consideration? There is a again host of provisions which are given under the provisions, which says that different scenarios what will be full consideration. But in a normal scenario, whatever amount which you receive on a sale of a property is considered as full value of consideration or sale consideration, as we normally call it. But yes, there will be different ways. So not all sales will be direct sales that you sell a property and you receive an amount. Sometimes you don't even receive an amount, but you receive something else in exchange of that, or the receipt is deferred, or the receipt is exchanged, or there is some other settlement. So what is full value of consideration has to be determined. In various cases, in various deeming provisions, it is not necessary that full value of consideration is similar to what is received. So because the deeming provisions normally tax beyond what is received, and that is why what is full value of consideration is very important to as a starting point to compute capital gains. Full value of consideration will be reduced by any expenses towards transfer. So if there are any expenses which you incur inextricably linked to the transfer. So what is an expenditure which is allowable is also subject to litigation, because nothing has been specifically pinpointed into the Income Tax Act, but one has to go with a normal logic and general parlance that if any expenditure is specifically taken for the purpose of sale, then that has to be considered. Then you have to obviously reduce the cost of acquisition, and cost of acquisition will have two things. I have not got into the indexation because we all know that what is indexation of cost of acquisition. So whenever there is a long-term capital asset, there will be indexation provisions which will apply. So if there is any indexation, you will reduce index cost of acquisition. And if there is any cost of improvement, there will be that particular improvement cost also which you will reduce from it. There are certain specific provisions which I have specified in the presentation for reading purposes, which are specified for non-residents and for indexation. So that is one provisions of 48 which may one read for computing the computational provisions. This is just an outlay to explain which I just mentioned, that how will you derive at the gain or loss. What is cost of acquisition has been mentioned under section 49. So these are different 6 or 7 scenarios in which how do you determine the cost of acquisition. So normally cost of acquisition is when you purchase the particular asset. But in these 6 cases, when there is a distribution of asset by partial or complete partition of HUF, whether if you have received it by gift or a will or by succession or by dissolution liquidation, then you will have to take the cost to the previous owner. That is section 49(1) for us, which says that if I have taken that, then you will take the cost to the previous owner, and even the period of holding you will consider to the previous owner. So it will be long-term or short-term based on that period of holding. Also, one important point or development, obviously 56(2) sections, which is the gifting provision sections, were always there. Now, since last few years, we have 56(2)(10) also, which is included in the provisions. So in those kind of deeming provisions, when there is a fair value which is attached to the property and there is fair market value which has been ascertained, then that fair market value will be considered as cost of that particular asset. So suppose if you are receiving any property or any gift from a friend and it is being taxed under income from other sources, then the amount which is taxed as income from other sources will be considered as your cost of acquisition as in when you sell that particular property. So this is specific. I think, yeah. So there are specific provisions when it comes to, as I mentioned, that there are certain specific sections. 3 most important specific sections I shall cover in a couple of minutes. One is in case of depreciable assets. How depreciable assets has to be computed, I have provided in this particular table, that for that depreciable assets, you will have to specifically consider that whether it is a block of asset or not. If it is a block of asset, then the resultant capital gains by default will always be short-term capital gains. And how do you compute? There are different methods which has been brought about that I have given here. Specific provisions are given by way of slum sale. In short, slum sale means when there is a sale of an undertaking, when you cannot individually put value to small tiny assets in that particular undertaking and you sell the entire undertaking as a whole, then it is called as slum sale. And in that case of slum sale, how do you consider it? How do you compute it? What will be the full consideration? What will be the cost of acquisition? That is provided under section 50B of the provisions. There is a fairly new section, not too new, but 50CA, which is whenever you sell any unquoted shares. In that case, see, when the shares are quoted in the equity market, you know the value of the shares which has been traded in the market. But recently there has happening that there are a lot of promoters, lot of private placements, wherein there is, a different kind of mechanism which is being done, where the value of the share is huge. However, it has been shared or parted away at the face values. To avoid those kind of things, there is 50 CA provisions which says that whenever you are transferring an unquoted share, the fair market value, which has to be determined as per the rules, Rule 11 UA, that will be considered as your full value of consideration. And based on that, you will be computing your capital gains. So Section 50C is a specific provision for that. Now coming to the last specific provisions, which is Section 50C. Now, Section 50C is a deeming provision, as we all know, which says that whenever you sell an immovable property, if the value at which you have sold that property is lesser than the value of stamp duty, which is the stamp duty registration value, in that case, the stamp duty value shall be considered as your sale consideration or full value of consideration for computing the capital gain taxation. The only relevant point I would like to mention here is that now there is a tolerance limit. Earlier, the tolerance limit was 5%. Now the tolerance limit is 10%, which says that if the difference is ranging up to 10% of the value, then in that case, you will ignore Section 50C. In that case, it will be allowable as per the agreement value. However, if it is more than that, then you will have to compute the value accordingly. And in some cases where you feel that, there is some logic or reason why it is less than the stamp duty value, then you can definitely challenge the stamp duty value, and you can also ask the departmental valuation officer to recompute the value based on specific circumstances. As I mentioned, that there are specific exemption sections from Section 54 to 54 GB, which are investment linked exemptions, that for in which kind of property, on what kind of reinvestment you will have to be given the exemptions. I think with a lack of time at my hand, you might read these provisions from Section 54, but those are very specific and I have brought down the conditions, the criterias in each of these sections, and in which criteria it will be available. So that all provisions I have, I think, already specified here. The only one thing which I would like to specify, when it comes to controversies under these particular sections, because all of this is just reading material which can be, easily be read by everyone. But one of the important controversies in such kind of provisions is that all of these provisions have lots of conditions. Every section has different conditions, and there might be, in fact, there are several or plethora of cases when the assessee, due to practical considerations, is not able to follow the conditions. What happens in those cases? So in those cases, one of the thing which I have noticed out of my practice is that these are beneficial provisions. And when it comes to beneficial provisions, the courts have always given, in most of the times, they have held in the view of the assessee, saying that these are beneficial provisions. If the assessee is not able to do any procedure as per the conditions, that should not be a point of not allowing the exemption. So whenever there is, there is 2 years period or 3 years period, or there is certain time period that you have to file before the return of income or before the belated return of income. So all of those conditions or parameters, if not met with, there will be judicial precedents which will help the assessee, saying that these are beneficial provisions. And normally, immovable property transactions do not exactly happen the way they are conceived or perceived. In practical life, there are a lot of issues, it is not necessary that the constructed property will be over in 3 years. It is not necessary that the assessee will be able to file return in time. Recently we had COVID situation, the returns were delayed. So there could be a lot of genuine difficulties involved. In such cases, one has to take shelter to the judicial precedents which are available. So yes, that is it with my session. And I'll be happy to take up all the questions by the participants.
A very good evening, Kinjalji and all the participants. Really, it was a very nice session. You have elaborated all the provisions in very simple and understanding way. So, I am CA Shalini Gupta. I am a Northern India Regional Council member, and basically, I am from Ludhiana, that is in Punjab.
Okay.
So, uh, uh, I request all the participants, if you have any questions, I have opened the question and answer. That is, there is just one question in it. Kinjal ma'am, the question is amounts or assets, for example, mutual fund shares, LIC death claims. If these are received on the death as a legal hire, the person who has received as a legal hire, is he required to be these things to be required to be disclosed in ITR? And if yes, where to disclose these things?
Okay, so could you just repeat what has been received as a,
Yes. For example, mutual fund shares, LIC death claim, etc.
okay. So yes, so answer
Received
to
by
this.
legal hire.
Okay, so the question is that whether if you are receiving any gift, then whether it is to be specified. So there are two views to it. There is a conservative view and an aggressive view. If you ask, my personal view to it would be that if you are receiving any shares or mutual funds or any gift which is in kind, in that case, you may not have to put it into your income from other sources schedule or an exempt income, because it is exempted under gifts are exempted and you are receiving right now. So in that case, it is not your income, because even as per section 56(2), any gift which is being received is exempt, so you need not give. However, at the same time, there is a schedule of asset and liability in the ITR. So if your gross total income crosses the specified limit, in that case, you have to give your assets and liabilities. In that case, you might have to disclose the value of that particular gifts. So that has to be taken care of. But if you don't exceed that, then there is no requirement to give the details in the ITR.
Thank you, Kinjalji. I think in question and answer query format, there is only one question. If anybody wants to ask question, he or she can post it. Otherwise, I think you have elaborated all the things very nicely, and there are no more questions. And I'm really thankful, Kinjalji, as you have elaborated, you have
Yes,
spared your
yes.
valuable time.
Thank you so
So-
much, Shalini, and thank you to all the participants for their patient listening.
Yes, thank you. Thank you, everyone, for participation, and we hope, looking forward to all of you participating in a regular program. So thank you all. Thank you, everyone. Someone from technical support?